Welcome to Blaxe Academy, and also welcome to this December 2nd Make the Play PTA. The entire point of PTA is to help the trader simply become better, naturally improve, and develop consistent profits and good decision making over time. I'm excited about this Make the Play PTA because as we're rounding out this crazy year, this was one of the best trades of the year for its simplicity. But before we get into the play, I want to go over a few things to make sure that we're all clear. In this Make the Play PTA series, we will talk about a number of trades, a number of markets, and also a number of strategies that may not be good for everyone. But to learn more and to understand is the goal for everybody. That's the whole reason we have Blaxe Academy. So this type of trading that we're going to talk about today is risk event trading. You may have never heard of it. But first, what's a risk event? A risk event is any financial market event with an uncertain outcome. We don't know what's going to happen next that traders and investors alike deeply care about. They want to know what's going to happen. They spend a lot of time, money, and resources on trying to figure out what's going to happen in this risk event. Why? Because risk events create drama in the markets, they create volatility. And for traders, this can be a very opportune thing. For investors, not so much. So they may have to do something else in their trade or their handbook, depending on what happens. An example of a risk event would be any periodic economic report that tells some more about the economy, about financial conditions, or a group within a certain market. One example would be, of course, the non-farm payrolls, which we're going to talk about in just a few minutes. Another example would be a speech from a central bank chairperson like Jerome Powell for the U.S. Federal Reserve, or any number of banks like Christine Lagarde from the ECB, or the details of a long-awaited deal announcement or a trade like Brexit that can basically reshape the financial market as we know it. Now, what's so big about risk events? The good thing is they're pretty immediate. If you're trading risk events, once the event happens, the volatility in the market happens, the magic happens, and you get a response. It's really quick. It's sort of like trading, for example, earnings reports. But in general, there are two different ways to trade risk events. You can get ahead of them, make your positions known ahead of the event, or you can wait for things to transpire, wait for the volatility, or at least the initial volatility to roll out, see what everything goes, see what the data has to say, and then make your plays afterwards. It's pretty simple. I tend to like to trade ahead of the news, and that's part of why we want to bring this to you is part of Blaxe's strategy to trade ahead of the news. But we also have strategies that can trade after the news events occurs as well. It allows you to have success on either side of the event. And this is why we bring risk events to you, just like we would bring day trades, which people love, and also position trading and swing trading and all the other strategies. This is another thing that you too, as a trader, as a student of the market, can learn and also have as an opportunity for yourself. So now let's get into the non-farm payrolls. As stated before, the NFP report or labor report shows how the labor conditions were in the prior month in the United States. There are other labor reports for other regions, but for this one in particular, it's a risk event with a smooth period in which it occurs. Every first Friday of the month, look for this report. It's at 8:30 a.m. Eastern, 7:30 a.m. Central. Look for it. It's going to have many components. Sometimes they're going to be talking about average hourly earnings and wages and things of that nature. But the two main headlines are going to be about how many jobs were added or lost in the prior month reading, and also the unemployment rate, how many people are not working as measured by the Bureau of Labor Statistics, BLS. In the month of not October, in the month of November, there were 263,000 new jobs added, and that's actually higher than the consensus of 200,000. You say, well, where does this consensus come from? Well, look no further than your screen. The screen shows a bunch of bank economists from all sorts of banks from all over the world, the too big to fails, plus some of the ones you may not have known, like Societe Generale, Lloyd's, Barclays. But no matter what, they spend a lot of money, a lot of time curating these estimates. And to be honest, I don't know what they're for. I've been trading this NFP for almost 18 years now, off and on through the years, as it is important to what I see in the charts. And I can tell you, I derive a lot more information from the charts than I do from their estimates, because I will tell you that these estimates really don't matter to a hill of beans in the short term. Maybe in the long term, it does, but we predicate ourselves on saying, hey, you as a trader, if you know your charts, if you have some skills and you know your patterns and you can manage risk, you don't care about the reports. You care about what the chart says. And these types of events, like NFPs, like CPIs, PPIs, all the reports, especially the Fed rate decisions, they're great days if you're prepared as a trader. NFPs offer playmaker opportunities. This is why we call it the Make to Play series. The NFP, just like the CPI report, just like the Fed rate decision, offers several opportunities across a number of markets. All you have to do is know what to expect by looking at the charts, know what markets to play, and follow your trading process to those opportunities to make good decisions and win out over time. So now that you know a little bit more about the NFP itself, you know that it's, again, the first Friday of each month, which makes it a recurring thing that you can play off of. You can tee off of this. You need to know a little bit about the markets and how it affects it. We talked in our last CPI report video on how CPI gives some insight into inflation. Well, the NFP gives insight into how the labor market is in the United States. Well, you say, well, what does labor have to do with anything? It's kind of an everything deal. The more people that are working, the more people that are earning money to spend in this behemoth economy that we have in the United States of almost $23 trillion of GDP. So it's plain and simple. If there are more people working, there are more people spending. That's generally good for the markets. And I do say generally because in most cases that is true. Now, what's more important in the short term to actually playing the NFP report is knowing which markets have which sensitivities. And what I mean by sensitivities is which markets are going to move the most based on the data. We're telling you, hey, you don't have to know the data, but am saying that you do need to know which markets are most affected. The plain Jane winner here is currency markets. This hasn't been the case recently, but over the long haul, and especially in the last few months, I'm starting to see an uptick in currency volatility in the NFPs. In fact, I was talking to my traders last month about the NFPs and said, hey, baby, we're back. Prior to this, currencies may not have been the most volatile. You could have said that equity futures, for example, the futures that trade on the S&P 500, like ES, the NASDAQ, NQ, and some of the bond futures like the 30-year bond, ZB, those may have been the most volatile. But as currency volumes and currency volatility has increased due to uncertainty about the state of affairs, not just in the United States, but around the world, the currencies are teeing off on the news that's in the NFPs, and this creates a beautiful environment for currency traders. So again, before we go, we're going to say you can trade any one of these markets. I would shy away from crypto You're not going to get much of a punch there. Some of the commodities that aren't probably crude oil and some of the metals like gold and silver, you're not going to get a lot of movement there. But in the currency markets, absolutely. Not all the currencies, because risk related currencies aren't going to play as well on the NFP as they would on something like a CPI report. Because CPI, that tends to show the risk markets, as we call them, a different take than the labor component does from the NFP shows to, as you might have guessed, any currency pair that has the USD in it, the US dollar, which, by the way, is the most circulated currency, most important currency in the world still. All the reports of the dollar's demise are from people that don't know anything about trading. Anyway, if you don't like the currency markets, your next bet would be futures. And again, that would be the financial futures, the ones that are for the indices like the S&P 500, NASDAQ, small caps, but also the bond futures. I like the 30-year because it's very sensitive. It's more sensitive than the 10-year or the 5-year. But that just depends on how you like volatility. Trading risk events is trading into volatility. I must say that. So this style of trading may be a little new, but the whole point is to make a very informed decision, a risk managed decision in a very short term period of time to get a very short term, hopefully, gain. And if not, then you'll keep your losses small because of risk management. But again, number one market to trade this, currencies. Which currencies? Anything that is dollar related tees off on the US labor report. That makes sense. Now, if you had to guess and you never traded currency before, I would tell you to look no further than the euro versus the USD as a currency pair. Number one, if you're going to trade Forex, I would say that's probably the one to look at first anyway, because it's the most heavily traded currency pair in the world. Now, the currency market has a spot market, which is what I refer to as the currency market. It's the actual spot or now price, but there's also currency options and forwards, and there's other parts. But of the spot market, the Euro USD pair dominates trading. The US dollar is involved in about 80% of all the currency spot transactions on a daily basis. And that's 80% of about 6.5, maybe $6.6 trillion in liquidity. That's huge. The other pairs that you can look at, and I have one highlighted for a very specific reason, it's because I traded that one, are the other major currencies, as they call it, the Australian dollar, the British pound, the New Zealand dollar, the Canadian dollar, Swiss franc, and also, of course, the Japanese yen. You could have traded or looked to trade any one of these. How you decide as a trader, based on our approach, is looking at the charts, and that's exactly what we're going to do now. Up first, we have the euro versus the US dollar on a 4-hour chart. In the currency world, we sometimes refer to this as the dealer chart. I like to look at it from a longer term approach. And as you can see, we can see all the way back to September of 2021. You don't have to do this, but it gives a good feel for the actual patterns and structures in the market. Even if you don't know that much about trading, you can see that the euro has been in a downtrend against the US dollar over this period of time that we see. This gives some color to what to expect. And the reason for it is pretty simple. The US dollar has been increasing in its interest rates, especially as we got into March of 2022. The Federal Reserve, to combat inflation, started raising interest rates. The European Union did not. So as a result, you can see that the dollar has gained. And when I say dollar has gained, the euro is losing strength against the dollar, which means that the chart should be falling. We see that all the way up to the middle of, or really the end of September, where you can see the euro starts to regain some of its strength against the dollar. And all of this stuff is very relative. Currency markets, I'll remind you, is the very first market that I traded back in 2005. I've been a fan since, because you get a broader sense of the world, but that's not exactly why I brought you here. What I brought you here to see is we have a downtrend into the end of September, And since then, we've started to push up. Does that mean that we've changed directions? It depends on your perspective. But for me in particular, I always default to a few patterns. By now, my trading repertoire has hundreds of patterns, but there are a few that come to mind. And for students at Blaxe, we introduce you to the most important few patterns to get you started so that you can build out over time. The patterns that I look for here are going to be those that I can measure and gives me a good usage of my other tools like my Fibonacci tools, which I'll show here in just a moment. But for the most part, you can see again, since September, we've been rising. What I want to know on this non-farm payroll is based on the chart pattern, will the market go up as it's continuing to do, or will it go down? Because what we do know is that the market will make a rapid move in either direction because risk events induce volatility. This is the shakeup. It's going to pop one way or the other. The dotted lines that you've seen here are natural levels of support and resistance. These are areas where the market will have a hard time getting over if it's resistance, or a hard time going lower than if it's support. You can see how the market has bounced around the levels as one level that used to be support becomes a resistance later on. This is some of the key principles that we use to really find the chart patterns, understand the dynamics of the market without having to really fumble over the intricacies sometimes that happens in the financial reports. Now, I have a good idea of what I'm looking at, and I've already pre-labeled some points. These are really points where support became resistance, and I see patterns, one of them that I'm going to introduce to you very shortly. But I think I'll come down in time. Instead of going to this 4-hour chart, I'll come down to a 2-hour chart. And as I thought, I start to see my patterns a lot more clearly here. One of the basic patterns, I call it the most important pattern of all chart patterns, is the measured move. The measured move is the fundamental and most basic technical pattern that we teach our students at Blaxe Academy. And basically, it's two moves in the market that could be going up or down. Orientation does not matter, but it's called measured because you can measure the levels of one and find out the other one. This is one of the, I think, the most useful pattern of them all. Part of the reason that the measured move is the most important by my estimation is because you can find it just about anywhere. All you need to do in a chart with a few things is look for something that looks sort of like this. Now, there's chart patterns and then there's actual chart patterns. Just measuring out or drawing out lines like this is not enough. The measure move actually has usage of the Fibonacci levels, which we love at Blaxe Academy because they give you precise levels upon which to make good decisions. And if trading is anything, it's all about decision making. So, in short, if I measure a move going up, then there's going to be a move in the opposite direction called a retracement. The next move is going to be related, meaning I can measure its length and therefore kind of give myself some expectations of what's going to happen based on what happened prior to it. This is the whole point of the measure move. I'll give you a few that are in the chart already, just starting really from my arrows. I can show you that there's a measure move here that goes to here. I'm really setting the arrow to this point. This is really where I'm stopping, but I'm drawing the lines out so that you can see them better. And you can see that the market stops. And this point is 150% of this initial move. If you've never heard of this before, it may seem a little bit weird, but this is why I encourage you to come learn more about the real technical analysis that can show you how to really move in the markets. And I just made one move and I was showing to here, but I can see now that there's actually more Fibonacci levels that can show me how the market moved all the way to the bottom if I just pick the right ones, like here, for example, you can see that this level, if I draw a straight line across here, lines up with actual lows. And that's off of that very first measurement. That's important because if you can learn these levels and apply them before the market hits, which I'm about to show you, you can anticipate to a great degree what market action is going to happen without having to know it. And if you're wrong, it gives you some bounds to say, well, hey, that didn't work out like I expected. I need to exit the market, because a lot of times it hurts traders that we hold on to losers way too long in hopes that something's going to happen. Using these technical tools like this measured move takes a lot of the ambiguity away. And I can show you all even down to the lows of the market here. See that there's a relationship here. As I'm going here, taking a measure from here, down here. Again, we have videos and entire courses on just how to do the Fibonacci part. But that's just a precursor. I'm going to get back to how I find my patterns that led me to this really, as I said, easy trade on the non-farm payrolls. And as a reminder, it's an easy trade for me, a trader with a lot of experience, and I know my levels. If you don't know the stuff that we're talking about now, this is as dangerous as any trade that you could possibly find. And if you don't know or use strict risk management, you shouldn't even be looking at this video. But I'm assuming that you're interested in Blaxe Academy, where we can teach you all that, or you're a really good trader. And I'm going to show you how to use the Fibonacci levels to find support and resistance. And we're going to take it around there from the patterns as well. As you can see, the latest price that we had, and this is heading into the news event. This is back in time. This is on Thursday, a whole day ahead of the news. You can see that this level market here hits at 78.6% of this prior move down. That to me is a key. This is one of the key things that I look for. And it's on a much bigger chart, but what this is telling me that actually I can get it a little bit better. I'm going to actually use 81% instead of the 78.6 to show if there's any. Okay, so that's giving it upper bound. Perfect. This shows me where the resistance is in the markets. And you can kind of look back and see that there may be a little bit above here. I can put on another level as well. This 85.4% level will also come in handy to kind of highlight the prior levels, just like as we go down and then bounce back up. Oftentimes you come to prior levels, as you can see, of market activity. But for the most part, I see a lot of noise in the market. So I'm thinking as we're rising back up here in the euro, ahead of this news event, this is as good of any point. If the market is going to move, it's probably going to move lower. The reason is because we've come into resistance. If this is truly resistance, the market will have a harder time getting higher than this point. So now I can go down yet another time period. And as you go down time periods, the market tends to get a little bit clearer to me because you can see some of the patterns come out. If you're not used to pattern trading, this can look a little chaotic, understand. But again, we love our patterns. We look for our measured moves in all the market activity. And I can see this pattern in a couple places. I'm sure some of you may be able to see it forming up here. Again, these are two very specific levels, by the way, which I will measure out. And if you actually take our measured move course, you can learn more than just a few and more than just a few variants. And you can see the market does exactly as we need it to here. Once you start finding a pattern, cool part about that also is that the markets, just like trends, tends to stay with those patterns for a while. And I know we've got a lot of lines on here, but one thing to pay attention to is this 100% I will show here. There's also missing an 88.6% line. My students would have gotten on me if I did not include it there. And up here at the top, I took it away. I'm going to redraw this 181.6 line, because as you can see, they spot significant turns in the market. ahead of time. As soon as you can make these measurements, you know that these are spots of resistance. Now, one of these measured moves that you may have missed is right here. And this is the one that my eye immediately caught, because if it's truly a measured move, the market should, at least in the short term, go in the opposite direction. This is strengthening my case originally, saying that I think the market is going to go in the opposite direction. As a trader, it's usually a good idea not to assume that you're correct on everything that you think. This is kind of a universal for life. But if you're able to back it up with a process that is proven, a process that is objectively based, like what we're talking about here, and you start to make your measurements, as I'm doing now, see the resistance forming. There's a lot of resistance forming in this area. And this led me to believe that ahead of this news, the direction of the market was going to be lower. Once again, I did not know a thing that's going to be in the NFP report that would say that the market would move lower. For reference, for the euro versus US dollar, the US dollar would strengthen. So the news, or rather how it's interpreted, would be as dollar positive if this euro versus US dollar was to move lower. Now, the opposite would be true. It'd have to be dollar weakness if the euro continued to climb. But this sets up on a fairly high level what I was looking for. And now we can kind of get into the weeds of the things and kind of set some of our levels. But you can see the accuracy of this in detail is absolutely amazing. And for reference, once again, the news event happens right about here. I'm in Central Time, so the news event will be here. As you can see, everything we have set up, and there's more things to come. There's more types of analysis. I could have got a lot more fancy with some of the elements that we do here. But using the basics of the measured move, I get to see that we're probably at a top here. And the next move, if we're going to have a big volatility inducing risk event, and we do, the non-farm payroll is among the most volatility inducing. It causes pops in the market. This looks like our play, looks good. So before I go any further, I'm going to introduce another concept, and this actually comes from the currency world. It's called correlation. What we see here, this is a euro that we're looking at. We see a grid that shows how well other currencies, and I could use other things as well, work together or move together. So the way you interpret this is the euro, of course, you had to blank out itself, but the New Zealand dollar, the pound dollar, Aussie dollar, and even the euro versus Canadian dollar, all these in these dark green with these 97s, their correlation is about 97%. So 97% of the time, as observed over whatever this period is, these currencies are going to move together. This is really important information because if you can find a pattern on one currency and you can find another currency that maybe moves more or gives you more bang for your buck, and they're highly correlated, you can trade it instead, or maybe you can trade it in tandem. It doesn't mind. The same thing is true if you find something that is not correlated at all. This is a check your homework type thing. If you see a pattern and you've come up with a thesis like I have that the dollar should be strengthening, the euro should move lower, then say the US dollar versus the Swiss franc here, which has a minus 95% correlation, it should be moving higher. And its chart should support this as well. What you're trying to break as a trader is confirmation bias. This is different than what you get from your technical indicators like your MACD or your moving averages. They just confirm what you know. But if you can use correlation along with your charts and your patterns, you have a higher probability of actually being able to check your work without fooling yourself into making you seem that you're right. Because you don't necessarily want to be right as a trader, you just want to be paid. So Keeping that in mind, one of the currency pairs that I took interest in because of its higher volatility than the euro was the pound versus US dollar. As you can see, highly correlated. So the patterns that I'm seeing in the euro should also be reflected in the pound. And so that's where we're going next. Now, on the 2-hour chart of the pound, you can see I have some markups. This would bring a little bit more of my fancy sauce into it in terms of technical analysis because I see a much larger pattern. It still breaks down into a measured move, to be honest, but it gets into some of the more advanced studies as well that I'll talk about it in a minute. We have pretty much a general move that moves here, but we're also going to have another move that moves in the opposite direction, as we see here. You should be able to see this on the chart right now. It's this move down, and then we kind of chop back higher. Believe it or not, all of this market activity is related by Fibonacci levels, just like we did in the euro. Start drawing them across as well, you will start seeing some of the same numbers popping up. And this also gives some credence to what's happening. If you start to be able to see the same patterns, correlation, statistically speaking, but also using the same measurements, it's pointing you in the right direction. This is what I needed to make my play. And I'll show you a little bit more about this, but again, this is just bunches of measured moves put together. The measure move to me being the most important because it's a building block. Once you learn how to measure a move, measures retracement, and then measures projection, you can go on to more complicated patterns. The core of my pattern-based approach to markets over the years, almost 2 decades now, is centered on Elliott wave. You may or not have heard of Elliott wave. You probably don't understand it, but the progression from the measured move pattern into this sequence of what we call waves is one of the things we also teach at Blaxe Academy, and our students delight in knowing that the market, according to Elliott wave theory, can also have not only structure, but also have a logical conduct in the way that it moves to and fro. One of the things that I will show you here, and this is part of our PTA, the pattern that I see on the pound versus the US dollar currency pair is this ABC flat. It's just oriented a little different. The one we have here is going up. The one I'm looking at in the chart is going down. You'll learn to differentiate those if you take our course. The magic that happens once you start to putting patterns together with logical sequences like you have in Elliott wave is you not only know what's going to happen next, if it doesn't go according to plan, you can change your plans and still be logically correct. But for here, just know that we have a pattern that's called a flat, where once it ends, it looks something like this. 3 waves, A, B, and C. What should eventually happen is that once B ends, C should come down here. But on this time frame, I don't really care about the entire move. Why? Because I'm trading on a very short-term thing, which is this non-farm payrolls. All I need to know is, has the end of this part of the wave finished? Well, it's pretty convenient that the place that it normally ends is around 81% of the prior move, anywhere from 81 to 88% of the prior move. But if you look very closely, and I move some of this out of your way so you can see it better, you can see that we're in the right range. I think it's perfect. And looking at some of the levels that I've already drawn that aren't Elliott wave related, but they show the same thing, you get the notion that this is the pattern I'm looking for. And there are some other uh, measurements that can be made going from the low here mark off this low so we can know what we're talking about. Low here. If I measure the waves from here to here, then I can take them from here. We have our really the same measure move that we had on the others. And once again, we have a lot of stuff. We have a lot of levels here. And apologize for those that aren't used to this, but notice that there's a confluence, that's what we call it, of levels here. And that tends to lend to us to our expectation, just like we had on the euro, that the market is probably going to turn there because it's a point of resistance. But for now, we're going to take it down to a very small time frame and really see what's happening. And this again is the best part to me because, well, I was there and there wasn't a lot of ambiguity in this one, which sometimes the patterns aren't clear. And I will tell you that when the patterns aren't clear, you stay clear of those trades. The reason I traded this one was not because of the news, at least not partially. I knew that the news could make something, but what I was confident in was the pattern at hand as we moved into it. Actually, I'm going to go down to a much smaller time frame and I'm going to speed through some of it now as we're able to get the gift of hindsight. And for those of you that know Elliot, you may recognize some of the patterns that are developing here as well. But the point of inflection, the point where something's going to happen is at the news event, which is why I say as a trader, you want to be able to get in before the news event. It goes back to our resistance point and then moves, as you can see, much lower. This was, to me, a technical work of art. This long candle is the one at 7:30. But you can see there's lots of activity here. And because we knew that of everything that we were pretty certain of, you could able to get in here. This is me putting a stop loss on the trade, honestly taking the trade back to prior levels. And this is your initial trade look. That comes out to 7.95, what we call R, which is how much you're risking. So, for example, if you're risking $100, you would lose $100 if the market continued to go up here. You got stopped out here, but you would gain 7.95, almost 8 times that. So you would get $800 to the downside if you sold from here with a stop loss above here and then exited the market at this blue line. That's a way to make almost 800 times your risk by taking advantage of a market move that you know is going to happen. You don't have to know what's in the report, but you know what the market tells you in terms of the chart pattern, in terms of the market dynamics, which at the end of the day are the most important things. That's the whole point. And I'll let it run because what happens is once you get your initial response from the market and it comes back to levels of support, it's actually going to run the opposite direction. And this is cool because for those traders that didn't get the chance to understand or work in here, or maybe they're in other markets, as currencies are continuous, you can trade them anytime, just about. There's opportunities for markets, for traders to get in on this trade to the other side, because even here, this makes another pattern. This comes back to support. It's probably going to continue to move higher. And we'll look at this in one more market as well. And this was just to remind you that you can play ahead of the news, like we show, if you have the technical skill to do so, or you can wait afterwards and make good decisions based on this. But again, you're still looking for the same technical levels. And you can see that this market walked down initially and then moved back up. And through the end of the day into the close of the weekend, it actually made a move higher, but that's to be expected as well. But that's why I played the pound dollar This was an easy trade for me. If I had played the euro, and I'll come back over here to show about the same thing, it was the similar trade because remember, they're correlated. All you have to do, you have your bounds. This is at 78.6. This is 81% level. And watch what happens at 7:30. The same thing that happened at the pound. They look generally identical. The only thing that's different is that the euro is not quite as volatile as the pound is. And I played the more volatile one to get a little bit more bang for your buck. But a smart trader that was able to enter here, let's say the trader entered here, could have kept a pretty tight stop on this one as well, actually tighter than the one I had, and still made a pretty incredible trade down through here. This is about 7-1 as well. So almost 8-1. This is a little bit over 7-1. Again, pretty strongly correlated. No surprise there. You can see the nuances in the currencies as it starts to move up. The retracement here was deeper on the euro than it was on the pound, but they were making the same type of move. And for a completely different market, again, you can trade the futures on the S&P. We can show I've already had the levels marked up. There's still that measured move that moves into here. I'll just show it right quick. This is from here to there. You can still see the confluence come strongly through that level. Off a little bit on the bottom. There we go. Yeah, that looks better. So we still have a lot of this stuff in the 88.6. As I come down to smaller time frames, and it's good to observe this on smaller time frames, there's a flat pattern from Elliott Wave, but it is also a measured move here as well that looks something like this. Goes here, takes a long time, and then moves down. And we can play through this one as well. Change the speed down just boom. Remember, this is playing a future of the S&P 500. You can't play the S&P 500 at the time here because the market is not open. You can only start playing once the market gets through here if you're going to play an ETF. So, not necessarily advocating for futures, but at the same time, if you're willing to develop the skills, I think futures markets, just like Forex, which are higher leverage, more risky, more quote unquote dangerous markets, if you develop the skills, you can play here, and then maybe you can play your ETFs or your options once you get here as well. But as you can see, the move here was correlated with the currency markets. So all the markets here move sort of in the same direction. And that's good because they gave you a diversity. All it came down to now was which one of the chart patterns did you like the most? Which one of the ones had you studied or looked like the ones in your notes? This is why we have the PTAs. This is why we take the time to do this sort of thing. And hopefully, for those out there viewing and listening, this will show you a world of opportunities that's right in front of you. Whereas I find a lot of people have so much trouble with economic events. I did it too at one point in time because they seem to come out of nowhere and they often erase gains that have been made or just surprise traders. They become unforeseen things. There are still unforeseen things in the market, but they don't have to be these types of risk events. So in closing, this took a little bit longer than I thought, but I went over a little bit more detail than I wanted. I also showed this is some of the response I got from Twitter and the universe at large were traders that, again, are showing their grievances for the NFP. Sometimes people guess the direction right, but they don't understand if the move is going to whipsaw or what's going to happen. And they miss out and they complain, and these become more points of agitation and frustration than opportunities. But if you take away anything from this Make the Play PTA takeaway, you have to have technical skill to trade the fundamental news. I know that sounds weird, but it's true. Use known patterns. If you don't know the pattern, don't make the trade. You don't know or don't have to know what's going to happen. There's opportunities across the breadth of the markets. You have to know enough about what the event is to know which market to approach. For NFPs, we chose currencies. If this was CPI, we may have chose futures or something else. But it's knowing your markets, knowing your skills and combining those. And oftentimes, even if you miss, and this is going to happen a lot when you first try this, you can make the makeup play once you see what the market does, but it still defaults back to your technical skills. And that's why I say real technical skills matter. Now, if you're interested in learning these, gaining more skills, and developing more as a consistent trader, join us at Blaxe Academy. Otherwise, we'll see you at the next Make the Play PTA, where we'll be talking about another opportunity that you can take advantage of. Thank you.